Thank you, Shane. Thank you for that intro. Hello, everybody. I hope we're going to have a good discussion today on the mosaic of good governance in South African corporates and state-owned entities. What we're going to be doing is using case studies from lived experiences, examining structures, policies, and actions that we believe, as Futuregrowth Asset Management, are needed for good governance. And all this from the perspective of a capital markets investor. Right, so this is me. Shane, I think, has already said more than enough about me. I work at Futuregrowth Asset Management. I'm the head of credit there, and we are a third-party fiduciary asset manager. This means that we manage people's retirement savings. And some more information about us. We've got 190 billion rand assets under management. We have a fiduciary obligation to our clients. We invest their money for their benefit. And in order to do that, we need to make sure that it's invested in sustainable entities and that also generates an appropriate return for the risk. As a fixed interest manager, most of the investments that we make on behalf of our clients are in the form of loans. And like any responsible lender, we aim to ensure that the money we lend will be repaid with a proper return. We look at a range of financial and non-financial factors in making our investment decisions. And today, we're going to be talking about one of the non-financial factors, being governance. I'm going to talk for about 45 or so minutes, and following that, we're going to have a Q&A. Shane did go through the process of asking questions. I think there's a way you can chat. Otherwise, we can also, at the end, turn on people's mics and you can actually ask the questions. I do welcome the engagement with you, and so please keep those questions coming. I look forward to them. So at Futuregrowth, we think of the elements of governance as a mosaic, where there's lots of many pieces, different shapes, sizes, and colors, and they make up a complete picture. And where if a piece is missing, the picture is incomplete. And where a piece on its own, if you find it somewhere, it's largely ineffective at portraying the whole image. And so similarly, we believe that governance only works if all the parties in the mosaic of governance play their respective roles. Proper governance has various lines of defense, with different mosaic elements responsible for these different defenses. We'll go through what some of those are now. The first line of defense is within the entity itself and includes some of the things you can see on the screen there: effective decision-making bodies and processes, effective internal controls, ethical and professional leadership, good policies and procedures, transparency reporting, information and disclosure. These all form part of the first line of defense in the mosaic of governance. The second line of defense are those functions that we believe provide oversight. People like board members, company secretaries, internal auditors, the media, funders, capital markets, and shareholders all provide a level of scrutiny and oversight to be sure the companies are walking the right path. And also there's a third line of defense too. This is provided by external auditors, whistleblowers, legislation, regulation, and then also consequences and accountability so that something happens when wrongdoing is discovered. And each of these lines of defense, each of these pieces in the mosaic play a role in ensuring proper governance. All elements need to be there, and all of them need to be working for the picture to make sense. But you may also ask, what is governance and what is it not? What we've learned in our work on this topic is that governance is not something that happens in theory. It's not something in a document, in a policy, in a statement, or in an intention. To be effective, governance must be evidenced by actions, and it must be done by people that translate those documents, those intentions, those policies, and those procedures into actual outcomes. Without action and without the right people taking that action, governance is largely meaningless. And so the people, and we said at Futuregrowth, the who matters. It matters a lot. And so particularly when we look at independent oversight, I'm just going to click on independent oversight just to expand some of the concepts there. It's important for us to understand who is providing that oversight. Are they technically competent? Are they ethical? And are they free of conflicts between their own personal financial interests and the financial interests of the company that they may be overseeing? So independent oversight, as you can see from the slide, is provided by multiple participants in all the lines of defense. Oversight looks like this. It can be the second signatory on a bank account who may question an unauthorized payment. It may be a board member who interrogates a decision maker's conflict of interest. And it is also an external auditor who refuses to accept an incomplete answer to an audit query. Auditors, board members, creditors, ratings agencies, the media, us analysts, regulatory bodies, all have a vital role to play in ensuring that governance intentions are translated to meaningful outcomes, and importantly, must be able to raise the alarm, ask the questions, and take action when this is not evident. And so we're not going to go through all of the elements that are shown on the slide. What I'm going to do today, rather, is showcase some real-life examples where elements of this mosaic have been missing and which have resulted in significant governance breakdowns. And as I said at the beginning, these are not theoretical case studies. These are all recent lived experiences in our markets. And as I said earlier as well, I offer these insights from the perspective of a capital markets investor, representing a company that makes investments in these entities. Our analytical focus at Futuregrowth is to ensure that the money we invest is invested in entities that are sustainable and that are able to generate an appropriate return for our clients. Our view is that governance degradation over time can and does lead to financial degradation. And so why is governance important? An entity that is governed properly will be making decisions in the best interests of all its stakeholders, and it will be making decisions that make it a more sustainable entity in the long run. And as I said just now, as we have experienced, entities that have governance degradation suffer financial degradation and losses over time. There are real financial and other costs to poor governance, and we'll look at those examples a bit later. Turning that around and applying it in our context as capital markets investors, we believe that good governance improves the credit worthiness of a borrower and results in the higher probability that our loan will be repaid on time and in full, and that our clients will get the return that they deserve for the risk that they took. If a company is well governed, it will be more financially sustainable over time. This results, we believe, in a lower probability of loss for our investments. And if you remember what I said at the beginning, most of our clients' money is invested in loans. The form of that investment is a loan. Financially sustainable companies are able to pay the interest and capital that is due on their loans. We also believe that as responsible investors and signatories to the UN PRI and other documents on responsible investing, it is our duty to allocate capital to entities that are properly governed and sustainable. We are part of the governance mosaic as well. And further, the regulatory framework in the pension fund regulations also require us as investors and institutional asset managers to take ESG factors, ESG being environmental, E, S for social, and G for governance. We have to take ESG factors into account in our investment decision making. And so the regulations require this of us as well. And looking back into some history, we at Futuregrowth have been looking at governance for some time. How many of you remember these headlines back from 2016? When we publicly stated that we would be pausing on lending to 6 state-owned entities, SOEs, citing governance concerns. We named Transnet, Eskom, the DBSA, Development Bank of South Africa, the IDC, Industrial Development Corporation, SANROL, and Land Bank. And we expressed the view at that time, in August 2016, as I said, that pending the outcome of deeper governance reviews at these entities, we would be pausing on new lending to them. It caused quite a furore at the time. And up until then, we had not examined governance in any significant detail. Nobody had really. We had been making some assumptions around governance and oversight that we believed, again back in 2016, needed further scrutiny before we could commit our clients' money to fund further investments in these entities. And if we just pause on this date, I've mentioned it a few times now, August 2016, it was 5 years ago. It was before the then public protector Thuli Madonsela's State of Capture report, well before the Zondo Commission, well before much of the information that we now have about the governance degradation, the alleged corruption and malfeasance, state capture, etc., well before all of these things became part of our daily discourse. And so I guess we have to ask, in the 5 years since then, what, if anything, has changed? And this slide shows us some updated headlines. I'm not going to spend too much time on them. The screen will quickly flick through them. We all know these headlines. We all read the press. We all know what has allegedly been stolen. Most worryingly, I think, is that we all know what continues to be lost to poor governance and corruption, not just at SOEs, but at our corporates too. And we'll take a look at some of the names on the next slide. And the reports and the headlines that you see there and elsewhere throw around numbers in the billions and sometimes in the trillions. And I think sometimes we can become immune to these big numbers. So I'd like us to just pause for a second and think about what 1 billion rand means. I don't have to tell you, I think it's 1,000 million rand. There's 9 noughts to 1 billion rand. And if we put it differently, if I had to spend my time counting in this format, 1, 2, 3, 4, 5, where 1 second takes up one number, it would take me 30 years of counting to reach the number of 1 billion. 30 years for 1 billion. So let that sink in. So what role has governance weaknesses at corporates, SOEs, and within government played in these losses? We believe that governance failures have been at the heart of the alleged malfeasance and the financial losses experienced by each of the entities named in the slide. There are others too. These names have dominated our headlines over the last few years. We're all familiar with, again, the alleged financial irregularities, the alleged misappropriated money, the overblown procurement contracts, the self-dealing, and the unethical behavior. Whether it was the KPMG partner on the VBS audit, signing off financial statements and accounts that were riddled with fraud, whether it was the Tongaat Audit Committee, board and auditors looking the other way for those accounting frauds, or whether it was the overly optimistic lending in African Bank in 2014 that led to its collapse. All of these failures have their roots in significant failures in multiple elements of the governance mosaic that I showed you earlier. I'm going to spend some time on 3 specific examples from this list, chosen them because they operate in the capital markets. They are Transnet, Steinhoff, and Landbank. All of them issued bonds in our local capital markets, and as such, borrowed money from your pension fund and from my pension fund. The financial losses arising from these lapses in governance are meaningful, and we believe could have been avoided if the governance lines of defense, if the mosaic was evident, implemented, and working. And after those 3 examples, I'm going to talk through some of the Auditor General's recent findings at local and national government level, which echo many of the governance weaknesses that we have seen in these companies in our economy, and which perhaps more profoundly affect us all in the form of service delivery shortcomings, a weaker economy, stifled growth, high levels of unemployment, and a constrained fiscus. All of these examples on this slide have had multiple levels of governance failures. Unfortunately, we don't have time to do an in-depth analysis of all of the failures at each. And so I'm going to be focusing on just a few specific elements at each of the 3 names that I've mentioned, really just to highlight particular elements of the mosaic that were missing and that we believe likely contributed to the financial losses suffered by these entities and their stakeholders. And I also think it's worth remembering that in addition to the financial losses suffered by these entities, by their shareholders, by their funders, the financial losses continue and impact the rest of society. And they impact us in 2 ways. One is in the form of the culture of impunity that arises from the lack of swift, transparent, and meaningful consequences for these alleged transgressions. I mean, think about it. How many people have been held responsible for these alleged transgressions? Properly responsible, as in sitting in jail paying, doing the time for the crime. And the second cost to society, in both money and time, I believe, is that investigating and prosecuting those responsible, it is far more efficient and far cheaper, frankly, to prevent losses from happening in the first place than after the fact to try and unscramble the complicated web that these shenanigans usually involve. But I digress. Let's move on to the case studies. First up is Transnet. And so back in 2015, this was a slide we showed our clients. We were very proud, actually, to tell our clients that their funds in a consortium with 2 other funders had invested in a significant infrastructure investment, Transnet's expansion of their locomotive fleet, which has now become known as the 1064 project or the 1064 contracts. And the name comes from the fact that this deal involved Transnet buying 1064 locomotives in a capex spend that ended up costing 54 billion rand. That will take me 1,620 years to count to 54 billion. And the locos that they bought, the locomotives, were in line with Transnet's long-term strategy, and in the funding legal agreements that we were able to negotiate, there were some good, strong legal terms in there. And subsequently to this investment, we learned, alarmingly, that the procurement processes at Transnet were allegedly and significantly repurposed to ensure outcomes that were not in the best interests of Transnet. What we had assumed, incorrectly as it turns out, was that the independent and internal oversight mechanisms at Transnet were working. We had taken at face value that the management team and the board comprised competent and ethical individuals who were discharging their ethical responsibilities and their fiduciary responsibilities for the benefit of the company, rather than for their own or some other benefit. We had the view, assumption again, that the company had appropriate conflicts of interest controls, systems and oversight. They were well published in their publications, these intentions that I mentioned earlier. And we also believed that the procurement processes were robust, conflict-free, that they focused on value for money, and ensured that the locos were fit for purpose. But as events have turned out, and as you can see from the headlines, the contracts were irregularly entered into. And subsequently, Transnet and the Special Investigating Unit have now applied to the courts to review and set aside these contracts. Locos that were supposed to cost Transnet 38 billion rand ended up costing 54 billion rand. And what seems evident to us from this case study is that internal controls and oversight systems, two very critical elements of the mosaic of governance at Transnet, were broken. The procurement committee members, the CFO, even the board at the time, they utterly failed in their duties to ask the right questions, to enforce appropriate internal controls and due diligence on the procurement process. And what ended up happening was that there was the subversion of money intended to dramatically improve the country's infrastructure. It was subverted to other purposes. How did this happen? And how could we not have known? Well, one of the ways that this happened was that unsuitable appointments were made to crucial decision-making positions. And when I say unsuitable, it's either because there are questions around competency or there are significant ethical conflicts from those appointments. These appointments were seemingly made at the behest of other parties who, again, seemingly were directly benefiting from the inflation of the contract costs and the diversion inappropriately of the funds. Again, I come back to the point I made earlier. The who matters. On paper, it seemed as if Transnet had the appropriate systems and policies in place. But as we have found, these were largely meaningless, as the people in charge of these controls and oversight seemingly and actively went against all of these policies and did what they liked. And the second question I've asked, how could we not have known? It's a good question for us to consider, especially with hindsight, knowing what we know now. But back in 2015, we didn't know then what we know now. And as capital markets investors, we have historically relied on the view that the first and second lines of defense in the mosaic of governance are working. We have historically assumed that internal controls are effective, that oversight is rigorous, particularly when we're getting clean audit reports and the like. This view has patently been proven as false. And since 2015 and 16, we have spent much time incorporating into our investment decision-making process many more detailed questions and relying on evidence rather than words or documents to test this view with more rigor. And you may ask, how has this transaction impacted us and our clients? Their money was invested in this deal after all. What's happened? Well, as I mentioned earlier, one of the clauses in the set of funding agreements required that the interest rate on this loan increased each time Transnet's credit rating was downgraded. So as their credit rating deteriorated, so our clients were earning a higher rate of return. And since 2015, Transnet's official credit rating has been downgraded a few times. And as a result, Transnet has been paying a higher rate of interest for these loans. And as I said, this is appropriate for our clients. The risk has gone up. It's appropriate that they earn more and have benefited from the legal protections that were embedded in the legal agreements. But looking at it holistically, Funds that Transnet could have used for further capex have now instead been used to service a higher interest burden. And this could have been completely avoidable had the people in charge at Transnet done their jobs with the appropriate ethical and fiduciary mindset. And now more recently at Transnet, what's happening? There's a new board and a big cleanup exercise underway for some years now. New board and a new management team. They are actively looking to make right the wrongs of the previous administration. But at what cost? How much better for everyone if the first lines of defence and the second lines of defence, and frankly even the third lines of defence, had worked? Transnet would have had more money to spend on improving our rail and port infrastructure, and their executives could have been spending their time on the future, strategizing about growing Transnet, making it more relevant, serving their customers better, rather than spending their time, as they have done, on untangling and fixing the past. Okay, the second example I'm going to use is Steinhoff. And the mosaic of governance did not work at Steinhoff either. Let's look at some of the problems there. Again, many of us know the story of what happened. What we're going to look at is the governance failures that we believe can be traced as some of the causes of the huge financial losses suffered as a result of the demise of Steinhoff. And just to say at the outset, Futuregrowth clients had no exposure to Steinhoff bonds. For many years, we had concerns about Steinhoff, some of which I'll be talking about now. Some of the problems at Steinhoff can be traced back to the dominant CEO, which, when we combine it with a weak and ineffective board, led to significant governance failures. There was, as I've said, a significantly dominant CEO. There was a tight clique of his executives. And in the face of that, we believe that there was a heightened need for proper oversight of their decisions and actions. And it's become evident that there was a significant lack of this oversight at the board, particularly from so-called independent board members and also the auditors. Here was a board chock full of experienced, qualified chartered accountants. And yet, did they ask the right questions? Steinhoff was a complex business with significant accounting irregularities that have subsequently emerged. Did they ask the right questions? I believe not. And competency, remember this was a board of CAs, so they must have been competent at some level, but competency is only one element of the mosaic required of those tasked with oversight. Another element is the ability and the willingness to ask hard questions, to interrogate information critically and with an appropriate amount of professional skepticism. Steinhoff's business was very complex. Their corporate structure, too, was complex. They operated multiple businesses in multiple jurisdictions. There was a constant stream spanning many years of acquisitions globally. There were also a significant number of complicated intercompany transactions. And so the legal, the regulatory, the tax, accounting complexities of operating in this environment, to me, are mind-boggling. And then if you add in the ongoing global acquisitions, which we all know need integration of people, integration of systems of internal control, financial reporting systems, it's really difficult for us, I think for anyone really, to have fully understood what was really going on at Steinhoff back then. One of the other governance breakdowns in the mosaic, and in terms of oversight, was that Steinhoff was one of the few listed JSE companies that did not allow questions from analysts at their results presentations. This prevented a significant oversight mechanism from taking place, and I believe it indicated by their actions the view that management and the board had as to their lack of commitment to transparency and proper disclosure. And if we couple this with their poor corporate reporting disclosure, we as analysts had an inability to get proper information in order to be able to properly assess the risks inherent in this company. One of the other governance breakdowns as part of the mosaic at Steinhoff was a total lack of ethical leadership in the executive team. And if we look at the information that has been uncovered since Steinhoff's collapse about the significant undisclosed conflicts of interest for management and directors, conflicts between their private financial interests and their fiduciary responsibilities. This is a big one. There are multiple instances where directors were hiding their private interests in transactions with Steinhoff. This points not only to significant lapses in ethics and judgment, but also to an inappropriate management of conflicts of interests within the company. Again, I ask, Where was the oversight? Why was no one asking who was behind all these entities involved in these complex transactions? Why were these complex transactions even necessary? All these accounting experts on the audit committee and the board, where were they in all of this? Where was the board? Where was the auditors? And where was everyone's professional skepticism? Where was the enforcement of internal controls? Where was the regulatory oversight? Many elements of the governance mosaic, I believe, were broken or missing in the Steinhoff tragedy. Moving now to Land Bank. As the third case study, Land Bank's recent challenges, we believe, have partly arisen from the first line of defence failing, that of the executive team and the management being in a state of uncertainty and flux for a sustained period of over 18 months preceding the default. Land Bank had historically been a stable and well-run entity with oversight from National Treasury. The outcome of our detailed and engaged governance review in 2017 of the Land Bank confirmed an entity with appropriately constituted committees, appropriate decision-making authorities and internal controls, and a stable and competent and ethical management team. That changed significantly in 2018, when a series of executive resignations over a period of some 18 months resulted in the loss of steady and experienced hands at the helm of Land Bank. And we believe this is one of the causes of Land Bank's event of default in April of last year. And you can see from the slide there is an indication of these changes on the timeline. It started in December 2018. The CEO resigned. The CFO was then appointed as the acting CEO. And to fill the CFO spot, the General Manager of Corporate Credit became the acting CFO. The musical chairs continued 6 months later in May 2019, when the then acting CEO, who had only been appointed 6 months before, resigned. And then the acting CFO became the acting CEO. And the head of internal audit was then appointed in an acting role to be the acting CFO. A few months later, in September 2019, the acting CFO then resigned. And then his replacement became the General Manager of Finance, who became the new acting CFO. And then a few months later, in January of 2020, the head of Treasury resigned, and the manager responsible for funding and liquidity then became the new acting head of Treasury. Now, I don't have to tell you, these are all vital positions in any organization: CEO, CFO, internal audit, Treasury. Very important in any organization, but more so in a bank. And the result of all these changes in such a short space of time was a lack of oversight by the management team, the disappearance of institutional memory, and a plethora of individuals who were in acting positions and being shuffled around as execs were leaving. One has to question too what oversight the shareholder was providing. And then, so the last change happened in January. In April then of 2020, Land Bank defaulted on their loan obligations. And we are still dealing with the aftermath of that. The new permanent CEO and CFO were both appointed literally in the 2 months preceding the event of default. And so they walked into a crisis not of their making. The default remains unresolved today. And we, together with many other institutional funders, local and international banks, as well as DFIs, have been working on multiple solutions to restructure the liabilities of the Land Bank so that it resolves its event of default and is set on a more sustainable path. And so now, moving away from some of the names, we're going to take a look now at the Auditor General report on national and provincial government for the financial year to March 2021. And governance failures too, here over many years, as you can see from these headlines, and as they attest, have led to financial losses. The current Auditor General is Ms. Tsakani Maluleke. There's her picture there coming up on the screen. She highlights in this report on national government departments and municipalities, there are some alarming statistics. This relates to municipalities, what's coming up now. So for the year of 2019-2020, only 27 out of 257 municipalities have a clean bill of health from the Auditor General. That's 10%. Only 57 councils failed to deliver any financial statements so that the Auditor General could do her job, they failed to deliver their financials at all. 57 councils. The municipalities recorded 26 billion rand in irregular expenditure for the year. And it's going to take me 780 years of counting to reach this number of 26 billion. The Auditor General also highlighted in her report that irregular expenditure includes the overpayment of goods and not adhering to procurement rules. And she believes this 26 billion is probably an undercount because of the 57 councils that I mentioned in the point above that have submitted no financial statements. And so irregular expenditure is likely well north of 26 billion in her own words. And similarly, the former Finance Minister, Mboweni, reported in May of this year that 163 municipalities are in financial distress. 40 of them are in service and delivery crises, and 102 have adopted budgets that they were not able to fund. This is a worrying picture, but it is not new. The Auditor General has also reported that the year-end balance of irregular expenditure that has accumulated over many years totals 262 billion rand. We're now in the thousands of years of counting in order to get to this number. The irregular expenditure that you can see there of 54 billion for the 2021 financial year seems lower than the prior year of 66 billion. A sign of progress, one may ask, but the AG's report pours cold water on that thought. She reports, and I'm going to quote her directly here, she says, the reported amount could be higher as 31% of auditees were qualified due to incomplete information, and that if full irregular expenditure was disclosed, there would not have been a decrease from the previous year. In her report again, quoting her too, she says, these are not complex matters, but the basic disciplines and processes that should be in place at auditees: procure at the best price, pay only for what was received, make payments on time, recover the revenue owed to the state, safeguard assets, and make use of the resources of the state in the most effective and efficient manner, ensuring that value is derived from the money spent. Good preventative controls would have made all the difference. I'll repeat that. Good preventative controls would have made all the difference in her report. And so while the AG's oversight cannot be faulted, this is evidence that this is one piece of the mosaic in place in the governance of our national departments and our municipalities. But we have to conclude that her and her team's work is less effective and she says it herself even, when the mosaic elements that represent that first line of defense, the internal controls, the basic disciplines and processes, as she has described, are absent. The picture is not complete and governance is not effective with just the Auditor General's pieces of the mosaic in place. From a capital markets perspective, this is important because municipalities also raise capital from institutional investors, as does the national government, to fund their activities. All of our pension funds are likely invested in government bonds and in municipal bonds. And so we too have a role to play in ensuring that the mosaic of governance works at these entities. So what does good governance look like, and how can it be different for corporates and SOEs? While governance is important at both corporate and SOEs, and I have hopefully shown you in the examples, both can be susceptible to significant governance failures. There are some subtleties and differences between the two that one should be aware of, and these can be categorized as shown on those 5 categories in the slide, which we'll examine in some detail now. And so on the first point, the question of motivation. The directors of corporates are motivated to generate profits and increase stakeholder value, increasing shareholder value. If a company doesn't generate profits and stakeholder value, it goes out of business. Even Steinhoff couldn't keep up the charade forever. Contrast that with SOEs. The motives of SOEs and their boards are not always clear. They often exist for a public good, and they are also often monopolies. And so the discipline of the market, as imperfect as it is not always applied to SOEs. Further history and experience has shown that they are easily open to manipulation and self-interest, often with scant accountability. With this lack of clarity and capacity for manipulation comes a need for stronger lines of defense and different oversight mechanisms, different governance frameworks. On the duty of loyalty and the duty of care, we believe that most governance transgressions tend to arise either from a conflict of interest or a dereliction of duty. These are common in both the corporate and SOE examples that we have seen and that I have mentioned. Also similar between corporates and SOEs, whether they are for directors, is that they have the same fiduciary responsibilities. Different for SOEs is that in some instances, the requirements of the Public Finance Management Act, which is a piece of regulation that governs how public finances are spent, the PFMA, it states that the board of an SOE can be jointly and severally held liable for PFMA transgressions. Not that we've actually seen this happen. So this is another example of while the piece of the mosaic around regulation is evident, the PFMA has, in theory, strong protections to safeguard appropriate behavior. But in order to be effective, the other pieces relating to accountability are also needed. We need enforcement of the regulations. Otherwise, again, it's just a piece of paper. We need action on those pieces of paper. And I think it highlights, again, that no one element of the mosaic can exist in isolation of the others, or can be effective in isolation of the others. The third differences relate to the process to nominate and appoint directors. At corporates, what usually happens is there's a subcommittee of the board called the Nominations Committee that selects candidates for nomination to the board. Shareholders are then asked to vote in a transparent vote on these nominations at the annual general meeting. Before that meeting, they're usually provided with brief CVs and experience of the nominated members, so they have some idea of who they are electing to the board. This means also that a wide group of people, the entire shareholder body in fact, has a say in appointing directors at that company. Contrast that with state-owned entities. At SOEs, it is not always clear what the criteria for appointments to these boards are. And if we add to this the fact that the responsibility for the appointment process rests with one individual in a closed process, we can see some problems. At SOEs, it is usually the cabinet minister responsible for that entity to make the recommendation to cabinet for board appointments. So it would be the public enterprises minister for entities like Transnet and Eskom, and the finance minister for entities like the IDC and the DBSA. We on the outside have no insight into what criteria, qualifications, backgrounds or conflicts checks or any other suitability measures, frankly, are used in making these appointments. And we believe that this implies that additional governance processes need to be in place to protect against governance missteps. And linked to the appointment process is the possibility for conflicts between political responsibilities and director responsibilities. And while corporate directors may and have disregard their fiduciary responsibilities, this has usually been due to personal conflicts and unethical behavior. At state-owned entities, there is an added dimension. Sometimes due to the nature and method of appointment, often being a political decision, there may be political interests or loyalties that may conflict with that individual's fiduciary responsibilities as a director of that entity. And we believe that additional safeguards and oversight mechanisms are needed in these instances to ensure the appropriate management of this conflict. The last point where they are different between corporates and state-owned entities is in profits and bailouts. When corporates fail, the options are limited. The jobs and the careers of decision makers are on the line. And this tends to regulate board and management conduct, to a degree at least. It is not perfect, but it does provide a measure of defense. We contrast that with failing state-owned entities that are, in terms of our history, have been more often than not bailed out by government. We have multiple examples of this: SAA, Eskom, Denel, SABC, and many others. This results in fiscal damage and very little accountability. The careers of these decision makers are seemingly not always adversely affected, and they may end up being appointed in other roles elsewhere. And so, can we turn the tide on this problem? How do we do this? And what needs to change? And so, in general, I think that we're very good at identifying what needs to happen and identifying and planning what needs to be done. And where we're not so successful, I believe, is in the execution of these plans and accountability for when execution slips. For example, if we take a look at state-owned entities and their reform, SOE reform has been on the agenda since as far back as 2010, 11 years ago. Back in 2010, there was the appointment of a Presidential Review Committee on SOEs, and it spent 24 months conducting a macro review of all 715 state-owned entities. Did you know we had so many? 715, it's a lot. And following that 24-month review, preliminary findings were submitted, and 21 principles guiding SOE reform were drafted, and furthermore were accepted by the Cabinet of the time back in 2013. Were any of these principles executed? As far as we understand, nothing happened for a few years on these findings. And then another SOE Council, now called the SOE Coordinating Council, was announced in August of 2016. To do what exactly? No one knows. And to my knowledge, there was no communication nor any action from this body. That was in August 2016. And then in June 2019, so more recently, another council on SOEs, now called the Presidential SOE Council, was announced. And again, more recently, in the February 2021 State of the Nation speech that President Ramaphosa said, he had these 4 points to make on SOE reform. And I'm quoting directly from his speech now. Point 1, he said, to support our reform process, the Presidential State-Owned Enterprises Council has outlined a clear set of reforms that will enable these vital public companies to fulfill their mandate for growth and development. Secondly, overarching legislation for state-owned companies will be tabled in Cabinet this financial year and in Parliament the next financial year. Thirdly, a centralized SOE model is being implemented this financial year, which will ensure a standardized governance, financial, management, and operational performance framework for all SOEs. Fourthly, that the mandates of all SOEs are being re-evaluated to ensure that they are responsive to the country's needs and the implementation of the National Development Plan. This was the President's speech from February of 2021. And today is the 14th of October, 2021. And to my knowledge, there has been no public statement nor information about these actions on these 4 quite specific intentions as articulated by the President. And what's interesting to me, having followed this for some time, is that none of these intentions on SOEs are new. All have appeared as intended outcomes from previous deliberations, previous reviews, previous councils and committees, and previous government statements on SOE reform since 2011. Now imagine, where would we be as a country if some of the 21 principles recommended back in 2011 had been executed? All these plans, all these committees, all these councils, all these intentions, doing what exactly? We know that the SOEs need reform. We've known this for years. We even know what needs to be done. And the same trite sentences get repeated year after year after year. Frankly, it's tiring. And I believe that we need to do less talking and planning and much more doing. And for those Star Wars fans among you, I think Yoda said it best. He said, do or do not. There is no try. What needs to change is that we need to implement and we need to do. And we as investors have dominion over parts of that mosaic, so we can do what we can, and we must do what we can. But for the mosaic to look like a picture with complete pieces, every role player needs to play their part. As I've shown hopefully in the case studies, the mosaic pieces on their own are largely ineffective. The picture needs every piece of the mosaic to be in place. So the slide that you see here is a repeat from the slide at the beginning. Shown in grey this time are those parts of the mosaic that investors can participate in. things that we can be responsible for or use our professional judgment and skepticism to interrogate. We need to get evidence of what is really happening, rather than what the board and the management of these entities say is happening. This is what we as investors must do. I think we all know, and history has certainly shown us, there's a lot of misinformation out there. Companies and people don't always say that they're going to do, they don't always do what they say they're going to do. And it's up to everyone in the mosaic to be a little bit more skeptical and questioning, and to not be afraid to speak up when things are not right. So what needs to change? We need to focus on action and execution. If we look at the elements of the mosaic, many are outside our, as investors, direct realm of influence, but they are important to get right. Governance, as I've said a few times now, governance only works when all the elements of the mosaic are present and all of them are working. And so I believe we absolutely need to see action on a few fronts. We need, firstly, a vigorous strengthening and improving of systems of internal control for procurement and spending decisions, particularly at all levels of state-owned entities, government, municipalities, and corporates. We need to stop the leak in the buckets before more money leaks out of the system. Remember, it's costly to chase and apprehend wrongdoing. It's much more effective to enforce rigorous internal control and oversight systems to stop the leak before it happens. It's the first line of defense. Secondly, at government, municipalities and SOEs, we need to root out the conflicts that arise from state employees, their family and friends doing business with the state. We've seen it in the COVID PPE irregularities very recently. It is still happening. There is a need for there to be better checks on the people behind the entities contracting with the state. There need to be better disclosures of conflicts when family members of government decision makers are part of these companies. And we also need a much more rigorous method for costing all state procurement. To me, it's not enough that the lowest tender wins. The costs must also be benchmarked against reasonable market costs. And we should be avoiding cases where wooden handled mops are purchased for 200,000 Rand per mop. This is a true story. Look up Eskom and the wooden handled mops procurement matter. 200,000 Rand for one mop. Thirdly, I believe we need swift accountability for what we now know has happened, including timely and visible consequences. At the moment, there appears to be zero cost of wrongdoing. Why is Marcus Justus still swanning around Hermanus some 5 years after the collapse of Steinhoff? Accountability, one of the elements of the mosaic, is only effective if those tasked with enforcing accountability are able to do so. Where are the authorities in enforcing accountability and some real consequences? Another crucial missing piece of the mosaic. Fourthly, we also need to encourage whistleblowers to step forward. And importantly, we need to include much better and stronger mechanisms to protect them from the devastating consequences often of blowing the whistle. We all agree they need protection, but what are we going to do and what are we going to change to give them this better protection? At the moment, I think it's hard for people to step forward and blow the whistle. They've seen too many cases of careers and reputations destroyed, even lives taken, as consequences for blowing the whistle. Empty words don't protect anybody. And for this piece of the mosaic of governance to be effective, we are going to have to do some work on this. And fifthly, I believe that ethical leadership needs to be at the heart of every single organization. The right people need to be making decisions at all levels for the best outcomes for all stakeholders. At the moment, there are still too many implicated, compromised, potentially corrupt, incompetent, and conflicted people in charge of budgets, decisions, and boards at various levels in our economy. And so to paraphrase Yoda again, I think we need less comments and statements that say we will, and we need more comments and statements that say we have done. There needs to be ruthless and single-minded focus on action and execution by all the players in the mosaic. And so what have we, as Futuregrowth, what have we been doing? What actions have we undertaken? I'm going to highlight 4 of our most recent actions in the realm of governance from the perspective of capital markets investor. So, as you've seen, and as I've mentioned, we have focused on governance for some time now, since 2016 and the publication of our Governance Unmasked Learning Journey report. Furthermore, we've also engaged with our borrowers on governance metrics and progressing them on a path to better governance. This is all part of our analytical framework and investment decision making in SOEs and in corporates since 2016. As part of our analytical decision making, we ask questions. We highlight instances where governance weaknesses have been identified, and we make recommendations for improvements. We hold board and shareholder to account, and we direct our capital allocation decisions to those entities that are financially and operationally sustainable. Part of this has also meant that as we've seen the risk of these entities increase as a result of weak governance practices, so we have demanded a higher return for our clients. As an example that I mentioned earlier, in the Transnet Loco 1064 contracts, we built in a requirement that as the credit rating of Transnet declined, so the interest rate earned by our clients increased to compensate them for this additional risk. And as part of this process, we have a scorecard of questions that we ask on an annual basis of our counterparty universe, covering ESG, environmental, social, and governance factors, and we have a system for scoring or ranking them. We use this in our investment decision making to ensure that our risk assessment framework incorporates financial and non-financial risks so that we can adequately price or mitigate for those risks that we are prepared to live with. In some instances, like Steinhoff, the risks to us are unacceptable, and we have declined investment in those instances. Our scorecard has a list, and it's a work in progress, by the way, so it's always evolving, but currently it has a list of over 30 governance questions. And we, as Futuregrowth, have invested in over 220 different counterparty names. And so we're asking a lot of questions each year. We're getting a lot of information. And bear in mind, these are questions just on non-financial factors. Obviously, there's a ton of other questions on the financial factors that we interrogate as part of our investment decision making. So secondly, in addition to our focus on governance, we have long been agitating for much better lending protections and a bond market that protects investors. This is a means of ensuring that those entities that raise capital that raise funding on the capital markets are doing it on terms that adequately protect investors. We continue to do this. As you can see, this journey started, the slide says 2018, it was actually well before that, but the latest round of engagements were 3 years ago. And after this period of 3 years of engagement, we have better, albeit not perfect, regulatory requirements for the listing of debt on the JSE. And so while the regulatory framework is better than it was, it still has some gaps, which takes me to our third action. We have, together with our ASISA, that's the Association for Savings and Investments in South Africa, there's a committee at ASISA called the Fixed Income Standing Committee, or the FISC. So together with our FISC colleagues, we have turned our attention to embedding these ASISA standards for better bond market lending transactions. And what we've done from these ASISA engagements is to require better disclosure and reporting from capital market issuers. We believe that sunlight is the best disinfectant. Information is the lifeblood of analysts, and that transparency, information, and reporting allows us to better understand the risks and play our role in the governance mosaic. Focus areas that we are demanding better reporting on is on key matters like procurement spending and conflicts of interests, as we know that this is where the alleged malfeasance is taking place. As an industry body, the ASISA FISC and Futuregrowth as part of it is committed to improving lending standards on the bond market. And at Futuregrowth, we will continue to play our role, an active role in this. It's part of our responsibility for one of the pieces of the mosaic. The fourth action that we've undertaken is that of engagement. We have engaged with our borrowers, especially in our unlisted loan agreements, where we are able to negotiate much better terms. We've been able to incorporate specific requirements around governance. So what this slide shows you in the blue is an extract from the legal agreements of one unlisted borrower. This borrower was a small owner-managed company that we believed needed to go on a journey to enhance their governance and oversight frameworks as they transitioned from a small company to a bigger company, and as they were starting to raise capital from the institutional funding market, from pension fund clients. And you can see this extract from the loan agreement requires that after a period of engagement with them, that they agreed to establish an audit and risk committee, that they agreed for an independent external review by a firm of mid-tier auditors, which was different from the small auditors they were using, and similarly to appoint a mid-tier auditor with effect from a particular financial year. And in addition to these outcomes resulting in better risk management, better governance frameworks, and better oversight for their business, they have also benefited from lower interest rates on their loans. And so engagement with borrowers on governance matters and getting them to commit in legal agreements to better governance practices with time milestones and consequences has been the fourth element of what we as Futuregrowth have done. Again, it's a focus on action. And so we can ask, what can you do? Well, that depends on who you are and what you do. Where do you fit into the mosaic? What role do you play? How can you strengthen governance frameworks within your sphere of influence? It's important that we all reflect on this question and ask ourselves what we can do. Whether you're a company secretary, trustee of a pension fund, a board member of a corporate, an auditor, part of the media, or a funder, you have a role to play. Be skeptical, ask the questions, and don't be satisfied with half information or platitudes. If the evidence doesn't match the intention, then dig deeper. If you see something, say something, and do something. So I've said a lot. It's a lot to digest. And I think when you look at all the numbers and all what has been lost, it can be depressing. But it can be changed. And I think if we are to do one thing, it is this. We must take action, each of us, in our respective spheres of the governance mosaic. And John Lewis, who is an American statesman and civil rights activist, he said it best, I think, when he said, if not us, then who? If not now, then when? And so action and change starts with me, and it starts with you. And I think it starts now. So thank you for listening, and we can take questions now, if there are any.
There's Olga's contact details if you need to contact her. Olga, thank you very much indeed. I think we're done.
It's a pleasure, and thank you very much, everybody, for listening, for attending. Thank you, Shane, for hosting. Thank you, everybody. It's been good.